Briefing for Thursday, the 13th of October. I'm going to quickly have a quick wrap-up of what we had from the FOMC minutes last night, but overall being a largely a non-event, and then we're going to talk about the current market conditions, the open this morning. So starting off with the minutes, as anticipated, given really two factors. One, these are quite these are quite dated now when you think about it. We've had actually, in fact, two non-farm payroll reports since this actually came out. So the overall tone, I guess, was hawkish. That was pretty much as well to be expected. So the fact that they're quite dated, obviously no one's looking at really November as being a viable time for the Fed to hike. In between now and December, there's still quite a lot of economic data and potential headwinds to come. So the minutes overall discounted for that factor, and also the fact that largely a December hike now is pretty much priced in to full extent. I think we'll take a look at that shortly. We're up at nearly 70% now. The main take-home points then. Slightly hawkish feel to the minutes. They were going, well, we knew they were going this way, and obviously the timeline as well, but the main comments that were said were September was a close call. Participants believed it would be appropriate to hike relatively soon should the labour market continue to improve and economic activity strengthen. And so the main kind of comment that's being run by most of the major newswires and tweets and so on that you probably saw last night was along this line. Relatively soon. So when you talk about monetary policy and central bank code words, relatively soon is your new one, which means 2 months from now, essentially, subject to change, of course. But if you actually look at the market moves at 7 o'clock last night, minimal. But what you have seen this morning, just looking at my charts here in the middle left, you can see the DAX future. Let me just make this a bit bigger. You can see we've had that gap lower from the overnight session, which was negative in Asia-Pac trade. Bund futures likewise here on the bottom right, if I make that a bit bigger. You can see we've gapped up. So remember we had that chat with Piers yesterday, and when we were talking about when he comes in, his preparation through the morning, reading the FT, reading various investment bank research, all before he gets to the desk, and he already has a mind's eye of what the chart should look like. Well, if you were looking at the overnight news and you saw the Chinese data, then certainly you would be, and seeing how that moved the yen and weighed on overall sentiment, which was negative in Asian trade and weighed on most of the major indices overnight in that geographic region, I would be expecting that to follow through then into the European morning. If you think about the news being almost handing the baton from one region to the next, the fact that the FOMC minutes were really a non-event meant that there was nothing really to lead into Asia, and then with Asia, that's where the main news came out. And so that then feeds directly into how the European markets will open. So you can see here the negative connotations reflected in market price with a gap low in the DAX but a gap up in the Bund. Obviously the Bund now looking to close the gap, so that pivot looks quite interesting because that's pretty much the tick of where we finished last night at 9 o'clock. So I'll be keeping an eye on the Bund at that level. Great as well to see a lot of you proactive this morning, guys on the floor. Well done. I can see a number of you managed to take advantage of that move in the DAX when we saw a more aggressive break on S2 at the cash open at 8 o'clock. So very well done and well managed. A look at though Chinese data a bit more closer. You can see here the overall surplus that we had in the Chinese numbers from overnight was in fact the smallest trade surplus we've seen from the country since March. Exports fell much more than imports. In fact, if I was to show you this chart, you can see it more clearly. Exports fell 10% from a year earlier in September. In fact, 6 months of rising Chinese exports came to an end. So quite significant when you're looking at the trade balances, not just the surplus, but the export number is really key for China, obviously, given the fact that they export a large number of goods globally. So that data has caused this initial market moves from the open. What you tend to see now, and the thing that you need to be quite disciplined about for the lesser experienced guys, is that now a large number of you have had some excellent early trades here on the DAX. You caught that downward move. Now, as you can see, like with the Bund, we've already started to close that gap. And what tends to happen now is that you've got some decent ticks in the bag, and the key now is to not feel comfortable that now gives you a buffer. You shouldn't think like that. You should take each trade objectively for what's being presented in front of you at that time. So don't think any differently now as you go through the day. The other thing as well is that in terms of price impact, I would say now the large portion of that move has been done, and you've managed to get hold of it, and that's great. The thing now is not to be tempted in to try and think that now the DAX is just going to power lower and lower and lower. Now, that could be the case when the US come in. They might react to that if there is no other news between here and the North American Open. But what I'm saying is that the trade's done. It was quite a quick one in terms of execution, and then move on, and then look for the next opportunity. Okay, so moving on to some other things that we have seen. One is the S&P. Obviously, with this downtick that we've seen overnight on the back of the negative sentiment from the Chinese trade data, you can see the S&P here in the futures broke beneath that low print that was seen. Well, this was Tuesday, I think, and we've got 21 3/4 level that broke. But more importantly, what I've been looking at since the beginning of the week is that 21.19 level, a level of which you'll know was, if I put it on a daily continuation chart, that was the pre-Brexit resistance level. That point as well, where we tumbled on the back of Brexit and then broke higher and acted as support and early SEP. So that's the one of which we've been looking at. I know Citigroup strategists have been pointing that out for some time, but that has now been breached, albeit only by a couple of ticks. But this could be substantial for, I would say, overall market sentiment as we go into the US session. So I would be interested to see how the US take this technically, given the negative fundamental connotations from the trade data from China. What this has led to then is, I just mentioned Citi, but you're getting a lot of other banks start out. And this is what I do when I read the news. People often ask me about how do I assess sentiment, and how I do that is constantly reading what's going on. What are banks saying? What are analysts saying? What's the headline tabloid story at the moment? All these things give you a good insight into what's the word on the street, and then what's people's general consensus view. Because ultimately, what I'm trying to do to gauge sentiment is read the market's behavior, which is human behavior. What are people really focused on? And that will be the determining driving factor on a short-term intraday basis. That's the way I kind of look at the news. And one thing I've been picking up on is we're getting more and more banks and more headline coverage on, well, this is HSBC. There is now a very high chance of a severe fall in US stocks. Now, they're not the only one, but they're looking at, with US stock markets selling off aggressively on October the 11th, we are now issuing a red alert. The possibility of severe fall in stock market is now very high. I was reading something similar, I think it was from Credit Suisse, talking about elevated PE ratios that were at the same kind of levels on some metrics to when we had the dot-com bubble. So there's certainly a creeping sentiment coming in. As you can see here, other firms have issued similar warnings. Citigroup, head of FX strategists, telling clients that investors are not adequately hedging US election risk. And technical analysts at UBS calling for a top in the S&P 500 following the recent bond market sell-off that pushed yields above 1.7%. So again, this isn't maybe not right here and now to press the button to action a trade, but certainly this is the kind of thing where if you've got a lot of banks issuing, let's say, downside calls and potential correction in equity markets, allied to key technical levels we're saying that have been taken out in things like the S&P, this is when it becomes almost self-fulfilling in a sense. So just something for the slightly maybe longer term. The other, of course, big news that you're obviously going to get the Remainers. This is really going to push them over the edge. If you see some nervous-looking people waiting at the train tracks when you're walking home, the Remainers are very fragile in sentiment because might be pulled from the shelves. This is serious business now. This is where Brexit really becomes nasty. Pot noodles, cornettos, PG tips, and Dove. This is getting outright nasty now. It's a travesty. But one thing, again, from a serious perspective, kind of touching upon what I was saying about the human psychology kind of element, is that you're starting to get now that the pound, I saw on a trade weighted basis that was touted in the FT yesterday, the pound's trading at a 168-year low. These kind of comments, if you were to go on the Telegraph, the Times, the business section, which is typically in the middle of a newspaper, has now moved to the front page. It has now become high street news, if you like, not just for the financial market, but for ordinary people on the street. And the more of this type of news flow I feel that you get, again, if this starts to feed into actual people's spending habits, they become fearful then about, obviously I'm not talking about my might, I'm talking about people actually making a actual decision to hold back on purchase decisions because of the uncertainty now that we're starting to see in the market from the depreciation of aggressive nature of the pound. And if that starts to occur, then obviously this snowball effect starts to gather some pace, and then the downward spiral of sterling continues. And that's when some of these calls from various banks now issuing at 110, 105 in cable, we're up at 121 at the moment, start to become actually a valid target on the downside. So, if I go through looking at various different things, we've just jumped from the FT to Bloomberg, but these are all the headline stories this morning. Pounds plunge, squeezes UK companies as Brexit hedges expire. Interesting chart here is looking at the pound's volatility. So anticipated price swings at the highest now since July signal more turmoil. Now, if you look at the kind of price movement, actually the pound has offered up kind of some of the best trading opportunities in recent sessions. We all know that the trend is lower, but again, specifically, it's about getting the timing right. But you can see from the way that now option volatility is getting priced in that there's certainly more price fluctuations to come moving forward. And referendum day, you can see we were up here at around the 14 level, and we're not far from that at the moment. So this whole kind of pursuit of a hard Brexit line from the government certainly is having a clear direct implication in market pricing. There were some other things of interest that I did see in this article. So it cost the most since the end of July to buy option protection against a weaker pound when compared with those that hedge against sterling strength. So the 3-month risk reversal rate widened to minus 2.04 percentage points. So this is why people like Unilever are getting upset, is because the price of goods, if you like, is not getting passed on to the consumer. Now, if you were to look at this, the 20% fall or a 20% fall in the pound could cause import prices in the UK to rise about 12 to 13% and could lift consumer prices by an extra 4 percentage points over 3 to 4 years. That was actually according to an MPC member, Michael Saunders. And if you remember, it is, when the Brexit initially happened, you remember everyone was fearful about a potential spike in prices. Well, this is now starting to be what we could potentially see if we continue to see the pound fall at the rate that it's going. And obviously then that gives the Bank of England a real rock and a hard place scenario, because although the economy in terms of consumers in the UK might become nervous, and that then starts to see the wheels start to slow in the UK economy, you might tackle that with lowering interest rates in order to stimulate the economy. The only problem is you've got inflation spiking, and so you would counter that more typically by higher interest rates. So then this is the situation which the Bank of England are going to want to avoid. Obviously, other things that, front page of the actual paper, FT, UK faces Brexit divorce bill of up to 20 billion euros. Now, I think a lot of this to a certain degree has been priced in. I think I was talking about this with Jimmy in the live room this morning. And so that's why you haven't really seen a big downward shift in sterling. I think people have got used to this. But a continuation of these themes ultimately is going to mean that downward trend will remain in place for the moment. Quick look at another article that did come out actually late yesterday afternoon. Now, I'm not sure if you guys, amid all the Brexit focus, trade balance in China, this might have gone unnoticed, but so you're aware of the latest state of play, there was actually a Reuters exclusive about the ECB and QE. Now, if you remember what I was saying when the Bloomberg story came out, that was the Bloomberg source scoop that moved the euro when they talked about that 10 billion taper. Well, lo and behold, out comes Reuters with an exclusive to say the complete opposite. And so this is when, when you're someone of experience, you can almost predict what the news is going to be, just knowing the way that these news agencies work, and they try to counteract each other with stories. So actually the Reuters story, I think, is much more on point with how the market's general consensus is, and that is that the ECB may discuss technical changes to its asset buying scheme next week, but a decision could be deferred until December, when the bank will also decide whether to extend the scheme beyond March, according to sources. So again, this more in fitting. They're going to talk about potential changes, but nothing's actually going to be put into place potentially until December. And the key things here is that they're not talking about taper. What they're talking about is a compromise proposals around relaxing or temporary or partial basis a rule forcing the ECB to buy debt in proportion to the size of each Eurozone economy. They could potentially reduce ECB's purchase of German debt, risking renewed conflict with Berlin. Other proposals may include buying a limited amount of bonds yielding less than deposit rate. So these are all going back to the traditional ways in which we were looking at. They want to, if they're going to extend the program, tweaks towards the issuer buyer limit, maybe the capital key, all these other subtleties, rather than the outright hawkish taper story that we had. And so that's the current kind of state of play at the moment at the ECB. A quick look then at the calendar for today to wrap things up. This morning, actually, in terms of the European session, pretty light. There's nothing really too much now. Moving on into the US session, it's really the same. You've got import price, export prices. That's really, I'd say, second-tier data from the US alongside the initial jobless claims. Given the fact we had non-farms on Friday, I don't think that's really going to come into it too much this afternoon. You do have the energy numbers, though. And remember, you've got the DOE crude oil inventories. They'll be at the later time of 4 o'clock, which is always the case. And remember, Thursday instead of yesterday, because of the US Columbus Day holiday on Monday. On that note, let's just have a quick look at crude on the charts and how we traded last night when this initial number came out. So 9:30, this was the initial move that you had that I've circled for you. You can see a pretty decent move for an API release, 50.32. We ran all the way down to, the overnight Asian low was seen at 49.62. So a pretty punchy move for the APIs, and there is a definitive reason for that. So if we go back to the actual numbers, the crude headline was a build of 2.7 million. That was above expectations, but importantly, for the first time in 6 weeks, crude inventories rose last week by the most in actually 6 months. Remember, if you look at this chart here, you can see on the crude headline figure, we've been accustomed to seeing very large surprises to the downside, i.e. drawdowns. It's been very seldom the case we've had an upside surprise on the build. The build here then, the biggest, as you can see on the timeline here, in 6 months for the headline figure. Hence the reason you had that downside pressure in crude last night. Okay, so when the API or the DOE, come out later on this afternoon, you want to be keenly watching that headline figure, which the market now has positioned should be a build on that factor. The Cushing was a drawdown of 1.35 million. That was a surprisingly large, actually, drawdown, which may have negated some of further selling pressure from this initial move. Gasoline, a build of 688,000. Distillates, a draw of 4.5 million. So we'll be covering that again later on this afternoon before those numbers come out. Okay, guys, so going to leave it at that. I would just keep an eye on these index futures today. Not really too much calendar-wise. The data from the US, I'd say, is kind of a bit of a backseat. Nothing too important. What I am more, I'd say, concerned about is the fact that the DAX here, you can see, is just coming back down to test lows. The fact that we've got underneath 2119 coming on the backdrop of a negative Asian session. I'd just be interested to see the timings of when America comes in. Do they now start to put some real downside pressure on these index futures? That'll be what I'll be looking for later on this afternoon, because it's going to be certainly a more flow and technically driven day, barring any unexpected fundamental news. Okay, guys, enjoy your day. Well done with those guys who got on that DAX move this morning, and enjoy the session. Thank you.